Hi, everyone. I'm Ben Fisher, macro specialist on the equity sales side here at RBC Capital Markets, welcoming you to a special episode of Strategic Alternatives, recorded live at our TIMT conference in New York, Wednesday, November 19th, 2025. So I'm joined by two of my favorite partners at the firm, Amy Wu Silverman, who is our chief equity derivative strategist, and happy to have newcomer Callie Simpkins. She's specifically on the cross asset hedge fund sales team here at RBC. So what we'd like to do in these podcasts is just kind of get the lens and the view from different parts of the market. And since we were at a tech conference, really wanted to unpack the recent action in tech, which obviously tech equals markets, a momentum factor, and try and help investors as we go into the year end and into 26. So, Amy, I'm going to start with you. So, if you've been reading Amy's work throughout the year, which you definitely should be, she has been talking about the fear of missing out, specifically since Liberation Day, which caught people off guard, the massive rebound that we saw in risk assets. As a result, investors have been afraid to hedge for, again, missing that right tail, as you call it, kind of FOMO rip. And you have more recently been talking about how that's created kind of a false representation of the risk and the worry that is out there. We're starting to see that worry kind of come more to the surface. So, can you just explain in the derivatives market that kind of shift from the right tail FOMO dynamic, why investors didn't hedge into that, and what will happen if this downturn continues?
Sure, and great to be here. One term that I've been throwing around that is a little ominous, but I promise you it makes sense, is this idea of shadow hedging. And what I mean by that is right now in the options market, I think the demand for hedging, although this has changed a little, has been underrepresented. And Ben, part of the reason it's been underrepresented is this redistribution of risks that you mentioned, which is if you think about the narrative for 2025, and frankly, you think about the narrative since COVID, it really has been that you as an investor have just as much to worry about if you miss the upside as you do if you miss the downside. So a client told me, he's like, Amy, we're just a bunch of fully invested bears. And I really see that sentiment echoed among our institutional client base. So I know the three of us in this room have done a lot of macro events together, and oftentimes we'll say to a group of 30 clients, raise of hands who feels bearish. All the hands will be raised, and then we'll say who thinks the stock market will be up at year end. The same group of hands are raised, and my point just being you're much more weighted to that right tail because you have to be, because there's concentration risk and there is a career risk and a moral hazard to missing that upside. However, I do think there's a little bit more toe dipping now because we have started to see the narrative shift a little. We have started to see questions around AI and how much of this CapEx is circular. I think I've shared my favorite meme, which a client sent me, which is just a picture of a surge protector plugged into itself. And the point being, when you start to see this demand for downside, I actually think you'll see more come online when you see the market sell off. The reason being, people are waiting for that downward momentum factor confirmation. We keep getting it on the upside, but we have not so much gotten it on the downside. So that's why I call it shadow hedging, but it's just another way of saying there's probably more bears out there. They're just kind of in the closet.
Have you seen those bears get louder and starting to maybe hedge into the downturn like you were expecting?
They're definitely getting a little louder. It's almost like it's like a little bit more cool now to say that you're hedging. And a lot of it is people have done well this year. So you're starting to think about 2026 risk budgets. And I think it's just a little bit easier of a conversation now to go to your chief risk officer and say, hey, done well. Let's put this budget online for next year if we want to consider longer term hedges. And that pricing in the volatility market has gotten more pricey for that very reason.
Got it. And Callie, switching over to you, since you are credit expert, what has been going on in the credit market, specifically for those kind of bigger tech names? Is there real worry brewing? Because it does seem to be making its way into the equity markets.
Yeah, thanks, Ben. So happy to be here. My first time in the podcast studio with Amy and Ben. We work a lot together and we talk a lot together just to get a full picture of the markets across both equities and credit. Prior to my role on the cross asset hedge fund sales team, I spent 12 years in high yield and distressed credit. So it feels particularly interesting to be sitting at a tech TIMT conference talking about AI when I'm used to dealing with companies that are in bankruptcy and potentially winding down or liquidating or coming through a Chapter 11 process. So, first, happy to be here. Second, because AI has been at the epicenter of the market and is the epicenter of the macro market right now, particularly with NVIDIA earnings, but maybe even more importantly for the credit markets is Oracle earnings. I believe it's on December 9th. What we've really seen as of late is a shift of AI risks from the equity markets to the credit markets. And what I mean by that is over the past several months, there has been an onslaught of AI, what we call pop up mega deals in the investment grade market. What does that mean? That means that companies, these hyperscaler companies like Meta, Amazon, Google, are coming to the investment grade bond market with massive deals. There was just a deal from Amazon that was marketed for the $12 billion that got upsized in the same day to 15 billion. We've seen this happen multiple times, and they are raising money in the investment grade market, massive sums of money that aren't well telegraphed by the investment grade market to fund their growth and their capex. The issue is that these investors don't have clarity on the return on that investment. And they're basically just buying into a trust us story from the hyperscalers to absorb and buy all this debt. And so, as the risks get shifted from the equity market to the credit market via these pop up deals, and investors in IG are now long and exposed to AI. And there's also been a lot of articles written and headlines about these JVs and these partnerships from private credit with the data center companies. So, off balance sheet deals for building data centers that a lot of our private credit clients are also financing. So there's a lot of credit risk now to the AI trade. In this downdraft over the past couple weeks in the market that has been spurred by AI fears, credit clients are looking for ways to protect themselves now on that exposure. They're looking for hedges. There are not a lot of clean ways in credit to hedge your AI exposure. So CNBC has been talking about Oracle CDS, like you said. Now you've become, as an equity investor, equity salesperson, a local expert on Oracle CDS. That is getting a lot of the attention as the widget of choice for credit investors to hedge their AI exposure. That started blowing out. Oracle bonds started selling off. I think people are starting to differentiate Oracle from the other three major hyperscalers in terms of their credit quality, and that's coming under a lot of pressure relative to the bigger balance sheets like Meta, Amazon, and Google. But it's just showing that there is more scrutiny and concern coming from credit investors over the AI theme. What I will say is we did see a little bit of reprieve and bounce off the lows and turn in risk sentiment on the credit side as it pertains to AI because of the headlines that have been coming out of the White House between the Saudis and the US in terms of AI partnerships. It's unclear how much new news this actually is with the Saudis starting to collaborate with the US and invest in AI. There were some deals that were talked about back in April and May when we were meeting with the Saudis over in Saudi Arabia, but it's certainly headlines and a formalization of those earlier negotiations that are causing the sentiment to bottom here, at least locally. But NVIDIA earnings for the entire market, both equity and credit, is a huge focus and potential clearing event, or always potential risk to the downside.
That's a good segue actually to Amy. You have consistently written about the kind of skew dynamic on Nvidia, the AI trade in general. I think there's a hope and an expectation for everyone that owns AI stocks, which is pretty much everyone on the planet, that this will be a clearing event for the positive, and the worries that we've had will be in the rearview mirror after Nvidia beat and raises, which is obviously the expectation given the hyperscaler data points we've had. But there's like a little bit of note of caution for you, which is that chase that you would normally see, that forced gamma squeeze chase which has, on a beat and raise, forced investors, for lack of a better word, to chase the stock. That's not really present there. So can you just talk about how potentially, investors could be disappointed there won't be follow through even with a good event and a good number?
Yeah, I would say when you think about these bulwark earnings names, the market has shifted on them because one, there's such heavy concentration risk. But the second thing is it's all one big trade now. And that goes back to there is this element of the current correlation dynamics in the market, I think are also not a true reflection of how this has become one big trade, not only in equity wall space, but now, as Callie's discussing, in the credit space. And I'm actually curious, Callie, if some of those FOMO MOMO dynamics are there for your folks who feel like they have to buy the issuance for the same reason that equity investors do, if that's also carried over. But I will tell you what has been interesting for the last few quarters for a lot of the Mag 7 names, so not just NVIDIA, is we are starting to see less and less of that call exuberance, which is sort of the thumb of the scale of the right tail. A huge element of that, Ben, has been what retail is doing. Because the same reason that this narrative has been about not real hedging, but shadow hedging, FOMO and YOLO, is because it's not just an institutional element that's in our markets, it's a massive retail element, a huge tectonic shift from what we saw 5 years ago. And what do they love to buy? They love to buy the hyperscalers. They love to buy call options on them. That's largely absent this time around. Again, a narrative inflection could change that, but that has been the reason why we've seen these velocity of upside moves, specifically after April 2nd, to the point where institutional investors have become very, very wary of this. And their first question is almost always, well, what's retail doing now? Have they exhausted themselves? Are they running on fumes? Or is there still more dry powder? That to me is a little bit of the recursiveness that worries me about the market because part of what makes you buy the dip is when you see your stock market wealth and it's going up. So if we get continued days of stock market sell off, that has a psychological effect that I think cannot be underestimated, especially for a retail cohort that is usually expecting an up and towards the right market.
I would add that A, I haven't opened my PA in the last week, so shows you the hesitancy to buy a dip. And B, Lori Calvasina, in her recent weekly, because I was going to ask you about the retail dynamic, because it's like the FOMO chase, it has also been a consistent kind of cohort and support for the market. But she interestingly highlighted some retail exhaustion via whether it's Bitcoin, which is obviously sold off. And interestingly to me, it's on the rebound days that you get for some of these AI stocks. Bitcoin hasn't really participated. That's been a kind of a worrying signal for Lori for retail exhaustion. You also had just flows into passive equity funds, which are starting to kind of plateau, as is kind of margin debt, which has been up and to the right story and putting some juice to the retail trade. So it will be interesting to watch to see what happens. It's obviously widely expected as a good NVIDIA number.
Maybe, Ben, if I can ask you a question, because you obviously speak with a lot of institutional clients as well across different topics and sectors. But I know one thing that you've discussed a lot is just this idea of a possible rotation. So as we get a little weary of AI, where are the flows going? Do you expect that to continue? And do you see investors kind of doing just tactically, or is this a more strategic change for 2026?
Yeah, it's a good question. And the rotation hope always pops up. And it's been kind of a fool me once, shame on me situation as it always kind of reverts back to the big AI trade. And I will say that there are elements that it could be sustainable. The one other thing that's obviously been hurting risk assets is the Fed cut pricing, which in October was close to 100% for December. And given the kind of Fed's, whatever you want to call it, stubbornness since the FOMC, you've seen that pricing go down to sub 50% for December. And unfortunately, for many parts in the market that aren't AI, You really do need rate cuts, and you also need kind of an acceleration in economic growth, specifically GDP. So I do think you have seen it in pockets of the market, particularly healthcare, which if you look at just like the weighting relative to the S&P, it's still extremely low relative to history. It's just very hard for it to be sustainable, which is that always fear of like underperforming your benchmark if you get another kind of post liberation day rip, like if Nvidia puts up a monster number and you had kind of rotated in that, there's kind of reputational risk and there's also just like kind of capital risk. So it is something we'll be watching out, particularly this time of year going into the next year. You do see a rotation, but I think we would have to get more confidence that the Fed was going to cut again in December for it to be sustainable.
I have a follow up for you that's broader, but I'm super curious about this because you had said earlier that a lot of your clients are uneasy because for the issuance that's come on from the hyperscalers, they've essentially said, just trust us. We're going to make magic happen. And to some degree, it's worked in the sense that this issuance has been taken, right? I guess my first question is why? Like, why has there not been the pushback yet? And the second question is, do you think there will be if there is a further onslaught?
So, great questions. I think, first of all, these deals are getting done. And so there hasn't necessarily been pushback to the point of these deals not getting done, right? These deals are getting done in the public markets and also in the private markets with these data center JVs and private credit. There's a lot of dry powder and there's a lot of firms that have money that they want to put to use in this space. So these deals are getting done. What I would say is if you're thinking about Google, Amazon, Microsoft, these are massive, massive companies generating a lot of revenue, generating a lot of cash. So investors are fine, really, to price these deals. I would say, like I mentioned earlier, company that is starting to cause some angst in the credit markets has really been Oracle because they're no longer, and not that they maybe ever were, but they're not in that same tier. And so for them to be coming with massive issuance has really backed up the IG market in general, but the deals are still getting done. Oracle has widened out since they got their massive deal done. They're not being clear with the market about what their ongoing needs are going to be. And so the market is expecting more and more issuance from them. But Meta, Google, Amazon, these deals are able to get done. They're trading unchanged to tighter the last couple days. No real concerns or worries there yet, but Oracle certainly has been the name of choice that's starting to concern people and causing questions about the broader ecosystem.
Is there anything like switching away from like the AI stuff just in the credit markets, like the traditional high yield stuff? There is a view that the Fed is going to be behind the curve and they're late, and these job numbers, when they are released, are going to show a pretty marked slowing of the job market and the economy, and the Fed's going to be too late as they're sticking with this kind of hawkish message. Just curious of like from the cyclical, like traditional high yieldish stuff,
Yeah.
are you seeing any like concern over like slowdown in the economy would that would suggest that a worry is true?
I think that the consumer fears are definitely topical, top of mind, consumer finance. There was a lot of fraud fears in the aftermath of First Brands, Tricolor, Western Alliance that had a charge off, and maybe Zion that scared people right ahead of the major banks reporting. And people were worried that credit delinquencies and charge offs were going to be a big theme in the last go round of bank earnings, which largely they weren't. And so a lot of these fraud and credit and consumer fears got ring fenced and kind of boxed off, and we moved on from that, but there's still angst around that. And then in terms of the cyclical names that we've talked about, chems has been tough, autos has been tough, the housing end market has been tough. So there are real fears, and that is why the Fed decision in December is going to be so critical for the market. In addition to Nvidia, Oracle in the first week of December, these are major risks to have on our radar and pay attention to.
Yeah, and I would close by just saying that at this conference, those themes are very much present. There's been a lot of talk about the K-shaped economy, like delinquencies on the low end have been rising while the high end consumer has been holding up. And I will say, from a AI perspective, I haven't noticed any real fundamental concern. So it does seem like a sentiment thing. But as you know, sentiment can cause a lot of pain longer than fundamentals. But this is a great conversation and looking forward to doing it the next time. Thanks all.
Thank you.
Thanks for having me.
Thank you for listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on November 19th, 2025. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you'd like to learn more or continue the conversation, please visit rbccm.com/strategic alternatives or contact your RBC representative. See you on the next episode.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.